Okay. Excuse me. We're calling the meeting to order. Over the agenda. Move, we have a mover and a seconder. And, all right, let's go. Has there, anybody have any conflicts of interest on this agenda? Take that as a no. Let's move on to the presentation of the audit planning document by McMillan and Lawrence. So we give you the floor, then.
Okay. Okay, great folks, thanks for having us here today. My name is Darren Lawrence, and partner of Lawrence. This is Ross. Craig, he'll be leading the charge in the audit this year. For those that don't know us, we do have a planning letter here for you. Is that what's circulated?
Yeah.
We'll have a copy. Have one here. Thank you.
Since the rest of his stuff.
That's yours. So we will take you through our planning document here today. There are some changes, obviously, within the organization this year, and there's also some changes from an accounting policy perspective as well regarding asset retirement obligations. But we'll take you through our letter here, and if you have any questions, feel free to ask us as we go. If you want to take us through the letter.
All right. Good afternoon, everyone.
You know?
So we have the letter. It's in connection with the audit for the financial statements for the Capital Region Service Commission for the year ended on December 31st, 2023. The purpose in writing is to ensure effective two-way communication between us and our role as auditors and yourselves with the role of overseeing the financial reporting process. In this letter, we will address our responsibilities as independent auditors and provide information about the planned scope and timing of the audit. Request a response to some audit questions and any additional information you have that could be relevant to the audit. Auditor responsibilities. The respective responsibilities of ourselves and of management in relation to the audit of the financial statements were set out in the engagement letter that was signed by management on November the 19th, 2021. Plan, scope, and timing of the audit. Our objective as auditors is to express an opinion on whether the financial statements are prepared in all material respects in accordance with Canadian public sector accounting standards. In developing the audit plan, we work with management to understand the nature of the commission and to identify and assess the risks of material misstatement in the financial statements, whether due to fraud or error. Our audit plan has been designed to focus on the identified areas of risk. Materiality. For the current year, we determined an overall materiality of 120,000. We've also considered misstatements that could be material in qualitative financial statement disclosures. Materiality will be used to plan and perform the audit, evaluate the effects of identified and uncorrected misstatements on the audit procedures performed, as well as on the financial statements. The materiality amount will be reassessed at period end to ensure it remains appropriate. So for this year, there is a significant change during the period. The significant change we addressed in the planning of the audit in the current period are as follows, which is the asset retirement obligation, which is section 3280 of the Public Service Manual, effective for accounting years beginning on or after April 1st, 2022. So given your year end is December of 22, 2023 is your effective year.
In terms, so Ross, maybe we could just talk a little bit about that new standard and how and the accounting around it. What's going to change on the financial statements?
So the biggest change you're going to notice is in how you account for the cell or the site for waste disposal. In previous years, you constructed a cell and you wrote it off over the time it took to fill it, which was essentially 2 years. With the asset retirement obligations, you've moved from a cell by cell description of your site to an actual overall site, inclusive inclusive of everything that you had. Mainly because a cell is never really closed. And in previously, you would write it off over the 2-year period as you filled it. But now as regulations and everything change, you're allowed to go back, you're allowed to put more piping, and then you're allowed to put more layers. So you're allowed to revisit existing areas within inside the land that you have available to you. So instead of going, like I said, cell by cell, you now have a site. And the site has a useful life based on the amount of waste that can go on there. Asset retirement basically means that you are accounting for that site as a whole and what it's going to cost you to walk away from the site when it does reach capacity. So all that needs to be accounted for on day one. And then it gets, so your financial statement assets are going to take a large increase. Because, like I said, we've moved from a cell-based approach to a site-based approach. So most of those costs are coming back onto the books. And then from now until the site reaches capacity, that will be amortized back off. So you're going to have a large asset and a large liability. Okay, they both accrete during the year. And it's something that's going to be revisited every few years to make sure that the assumptions that are adopted now are still relevant in the future.
Yeah, okay, so we're basically adding more to your assets for the retirement obligation and also more to your liabilities. So we're not quite sure what the numbers are. We're working with management yet right now to see what the numbers are going to be, and then we'll work through with that, and hopefully we'll have a number when we present the financial statements to you. But it could be a $10 million adjustment. You know, we're not. Do you have any idea of everything?
We expect it to be significant.
It'll be yeah. So your statements will look different, but the good thing is, everyone else in similar organizations, their statements change as well. So it's just standard. We're going through with management just right now to figure out the numbers. We just want to give you a heads up on that, but that's going to be kind of the pipeline.
So the case here, the longer the legacy existed, the more the possible imbalance here. This is a new site. It would be, more of a wash as opposed to, some legacy.
Yeah,
sites.
if it was a brand new site, you would have bare ground. And you'd end up, you would, go to your different consultants and try to say, look, we're going to take X million tons of waste. We're going to be able to fill this in 40 years. What's it going to cost us in 40 years time to cover this all over and make it look like it was never a landfill? And they come up with the cost, what would it cost you to put the cap on it? Will cost you to put soil, what'll make it go back to make it look like nature, like there's never been anything there, like the tree cover, grass cover, like everything that needs to be on site to accommodate a waste facility needs to be removed at the end of that 40 years. So you're going to tear down your buildings, you just take the roads out, you have fuel tanks, you're going to have to remove those. Like those costs go as a day one cost under the new asset reporting requirements. And it has a massive liability with it. So day one, you'd have large asset and a large liability, even when we didn't really do anything yet.
Because what was no longer is because of a policy change. It's
Right.
nothing to do with the function of money.
No, it has nothing to do with the lifespan of your facility. The reason why I brought up the fact that you go from cells to a site is you never really close a cell. And that came up during our discussions, with management. It's like, okay, well, we've gone back and we've got, provincial permission to add.
Well, that was
higher.
a positive thing for the organizations. The cost of doing it otherwise meant more spread,
Right.
right?
Correct.
So going up higher, was positive, but now we're seeing that there's over this accounting policy change, there's a liability associated.
Well, the liability was always there. It
The
was,
policy didn't recognize.
that's right. The policy didn't recognize the fact it's going to cost you X million dollars to facilitate this. The only policy change that you had, or the only policy you had in effect was your post-closure costs, okay? Where you were trying to build an investment portfolio to cover this. Now you step back and you realize the cost of closing is an asset on day one. Okay, so you end up with a, like I said, you end up with a large asset, a large liability.
Is there potential that that's undercapitalized as a result of the new policy?
No, the post-closure is always based on tonnage.
And
That gets revisited as well.
and that's more to do with the funding of it, which is
Yeah.
the investments. The asset retirement obligation does not cover the funding model. So we'll still be maintaining the two unless the province tells us otherwise. Okay.
So that post-closure was always based on X dollars per ton going on the site. You were setting aside to help care for when you do decommission and, step away. That was not covered as a ARO change. Okay.
Yeah, the statements will look a little different, but yeah, we'll take you through the details at that time, and we just want to give you a heads up of that's coming down. Okay, oh, great, thank you.
Thank you for that.
To continue on, internal control, to help identify and assess the risks of material misstatement and financial statements, to obtain an understanding of the internal control relevant to the audit. This understanding is used in the design of appropriate audit procedures and is not used for the purpose of expressing an opinion on the effectiveness of internal control. Should we identify any significant deficiencies in internal control and the accounting system, we will communicate them to you in our audit findings letter. Significant risks. In planning the audit, we identify significant financial reporting risks that, by their nature, require special audit consideration. If there are specific areas that warrant our particular attention during the audit, or where you would like us to undertake some additional procedures, let us know. Uncorrected misstatements. When we identify an uncorrected misstatement during the audit, we will communicate them to management and request that they be corrected. If not corrected by management, we will then request that you correct them. If not corrected by you, we will also communicate the effect that they may have individually or in aggregate on our audit opinion. Audit findings. At the conclusion of the audit, we will prepare an audit findings letter to assist you with the review of the financial statements. This letter will include our reviews and comments on matters such as significant matters, if any, arising during the audit that were discussed with management, significant difficulties, if any, encountered during the audit, qualitative aspects of the entity's accounting practices, including accounting policies, accounting estimates, and financial statement disclosures, any limitations on the scope of the audit, considerations about the quality of a component auditor's work and how it was addressed by us, uncorrected misstatements, fraud or suspected fraud, and any other matters of governance interest. Audit questions and requests. So for fraud, to help us in identifying and responding to the risk of fraud within the entity, we appreciate your response to the following questions. First one is, what oversight, if any, do you provide over management's process for identifying and responding to fraud risks? Management's process could include policies, procedures, programs, or controls that serve to detect, and deter fraud. Second part of the question is, do you have any knowledge of any actual suspected or alleged fraud, including misappropriation of assets or manipulation of the financial statements affecting the entity? If so, please provide details on how the fraud or allegations of fraud were addressed. Other matters. Would you please bring to our attention any significant matters or financial reporting risks of which you are aware that may not have been specifically addressed in the audit plan? This would include such things as future plans, contingencies, events, decisions, non-compliance with laws and regulations, potential litigation, specific transactions such as those with related parties or outside the normal course of business, and any additional sources of audit evidence that might be available. We recognize your significant role in the oversight of the audit. We welcome any observations on the plan. This letter is prepared for the sole use of those charged with governments of the commission and carried out and discharge their responsibilities. Contents should not be disclosed to any third party without our prior written consent. We assume no responsibility to any other person. So circle back to the fraud. I have gone through the minutes of the board for the year. I never noticed any mention of fraud or anything like that. So is it safe to say that you did not encounter any fraudulent activity in 2023
If you're aware of.
that you're aware of?
No, that's what I know.
Okay, so that's great. Thank you very much. Are there any questions on our audit planning or audit letter here?
Judy has a question.
Just want clarification on uncorrected misstatements. When the second bullet, you say, if not corrected by management, we will then request that you correct them. Are you talking about this committee or all the directors?
It would be this committee that would be responsible for the oversight. But generally speaking, any misstatements that we find, we give those journal entries to management, and they've always posted all the past.
Oh, and I certainly believe that, and I trust that, but just for my clarification, I want to know.
It would first need to go to management.
Yeah.
And then that would bring anything to the audit committee.
Yeah. If we receive pushback, or sometimes you can get into, okay, management really wants to record certain things a certain way, either for financing purposes or whatever the reason, they don't want to disclose something or adjust record a liability, whatever the example is. Then if that's the case, we would bring to the audit committee the items that they didn't want to adjust, that we suggest should be adjusted.
The reason I asked that because management gets firsthand
Yeah.
insight on whatever's.
Yeah.
Could be wrong or not right.
Right. But let's just say there's a $2 million liability out there and they really don't want to post it, or $500,000 liability, they don't want to post it. We're really making an argument. It may not be material to the financial statements, so we could sign off on the financial statements. But if that's the case, we would let you know that management was really pushing to not record these items. So it's only at that point in time that we would bring that item to your attention.
But as usual, you always address these to management when you're working. with them.
Yes.
So you can work that out.
Yep.
First, and then you go back out.
But as I mentioned, historically, they post all of our entries. So that's the issue.
Okay.
Are there any other questions?
Anybody?
That's good, yeah. Okay. Thank you very much.
So at this point, we would go to an in-camera session.
Okay.
The auditors where staff would leave the meeting.
Well done.